In today's video, I'm going to tell you the top 5 tax write-offs for an LLC. Welcome to Millionaire Secrets. Here, you'll find an abundance of useful strategies, tips, tricks, and secrets behind success. We offer a wide range of topics that will get you one step closer to financial freedom. If you want to get financially free, make sure to hit that subscribe button and click the bell to stay notified of new videos. And make sure you stick around for the final tax write-off tip at the end of the video. We're only going to go through the top 5 tax strategies for LLCs to put you in a better position, whether you've recently begun receiving 1099 income, or maybe someone has told you that you need some type of entity structure. You might be a truck driver or perhaps wish to invest in a rental property and want to set up an LLC to protect your assets. If so, this video will teach you expenses that you can write off through your LLC. Let's get started. The first tax strategy for your LLC is startup and organizational expenditures or expenses. As a new business owner, you almost certainly will incur startup and organizational expenses. Startup and organizational expenses consist of any expenses incurred prior to the establishment of your business. So, let's say you spend money on marketing and advertising, or maybe you even spent money on getting some form of training and coaching before your business was established and operational. These are considered startup costs and operating costs. As a business owner, you are permitted to deduct $5,000 from your first year as startup costs or organizational costs. If your startup expense exceeds more than $5,000, that expense is amortized over the next 180 months. Meaning you have the ability to write off the initial cost of an asset over a period of time. Be very mindful of this when you file your tax returns, that you make sure that you include all of your startup and all of your organizational costs for your small base business. Number 2, the home office deduction. In 2020, we faced a pandemic if you're watching this video. Chances are you lived through it, so let's talk a little bit more about the tax deductions you can take as a small business owner. One of the most significant tax write-offs is the home office deduction. Most small business owners work from home, so how do we take advantage of the home office deduction? Simply put, if you have a designated space in your home or a designated room in your home where you do business, that is solely for business, you can use that space and leverage it as a home office. To do this, here is what you need to do. Here's how it works. You start off by getting the square footage of your home office. Once you have the square footage, you're going to divide your home office space by the entire square footage of your entire home. When you do this calculation, you are going to receive a percentage. This percentage will be your home office percentage based on the utilities that you have in your home. These utilities could include your water, cable, electricity, and gas. These all go into your home office expenses anytime that you are making repairs or maintenance or doing improvements to your home office. These can also go on as part of your home office expense. This is another way for business owners to benefit from some of the changes that they plan on making in their home as part of their home office. Number 3 is the vehicle deduction. As a business owner, you may need to travel to meet with clients, and chances are your vehicle will be used for business purposes. How do we ensure that the vehicle used for business purposes is properly leveraged? There are 2 ways to determine whether or not to take a vehicle deduction within your LLC. The first is to calculate mileage. When you own a business, you will be able to take 58 cents per mile driven in 2023. You may even be eligible for a $9,600 tax deduction from the IRS if you own an electric vehicle. For many Uber, Lyft, and truck drivers, mileage is extremely important because they track their mileage on various apps called MileIQ or QuickBook right from your phone. Consider how important it is to be able to track every business mile you travel in order to receive all of your deductions. Every mile you drive costs 58 cents, which can quickly add up, so keep that in mind. The second way for a business owner to take a vehicle deduction is by depreciating their vehicle within their business. A vehicle depreciates over the course of 5 years. So if you buy a $50,000 vehicle, you'll get a $10,000 write-off each year if you take a straight line depreciation. However, There are different methods for depreciating a car, such as a double declining method. This method allows you to accelerate a portion of your depreciation. Therefore, instead of waiting the whole 5 years to take a write-off for your vehicle, you are obtaining a bigger write-off. Tax Code Section 179 is the code that allows you to take a business deduction for a vehicle that weighs over 6,000 pounds. This means if you buy a vehicle, you can write off the entire vehicle through your LLC in the same year, reducing your taxes immediately. Now, we're going to transition to marketing and advertising. There is not a single business that runs today without getting customers through the door. If you're in business, you need to get customers in the door, which means marketing and advertising are critical expenses in business. When you are spending money on marketing and advertising, whether that's in the form of optimizing the search engine, websites, or flyers, this is a business expense that you get to take advantage of every year through your LLC. Unlike vehicle depreciation, you don't have to wait the course of 5 years because marketing and advertising are considered immediate expenses. They don't need amortization or depreciation, they can be written off within the same year. However, you need to make sure that they are not considered startup or organization expenses. You will easily be able to expense 100% of your marketing and advertising expenses. Number 5 is transitioning your LLC into an S corporation. An S corporation is a fancy term. Simply put, it is a special designation given to small businesses that meet the qualifications to be taxed as a partnership or proprietorship rather than a corporation. Since LLCs are a hybrid between partnerships and corporations, switching to an S corporation will eliminate the 15.3% self-employment tax that many LLC and sole proprietors succumb to. Keep in mind, you will also be able to take a tax deduction whenever you place yourself on the payroll. This is because S corporations require that the business owner pays themselves out of their business. As a business owner, you have the ability to control the amount of income you pay yourself and control the amount of income you're taxed at. As an LLC, you can decide whether you want to be taxed as an LLC, taxed as an S corporation, or taxed as a C corporation. Just remember that the biggest benefits of taxing yourself as an S corporation is eliminating the self-employment and being able to take a payroll deduction tax. Well, that's it for today's video. Hope you all enjoyed it. If so, please subscribe to the channel, leave a like on the video, and drop a comment below. Until next time, take care.